Alright, in this video I'm going to do chapter 3, number 31. I'm going to go over the journal entries for it and show you how to correctly do the process. So the first question says 1/3 of the work related to $15,000 cash received in advance is performed this period. So what that is you receive some cash, and what you need to do is the amount that you have now earned, you need to debit the unearned revenue account. Remember, it's a liability account, so when you debit it, that liability account decreases. So we're going to debit for the amount that we earned, and we earned 1/3 of the $15,000. So we earned $5,000, and we're going to credit. Now it's no longer unearned revenue; it's earned revenue. So we'll credit the earned revenue account $5,000, and when we credit a revenue account, then revenue increases. So let's go to the second one. Wages of $8,000 are earned by workers but not paid as of December 31st. So when when that salary is earned, we want to debit an account called wages expense, because we want to make sure, and this goes with the matching principle, we want to make sure that we put the expense in the year in which it was incurred. So we want to debit the wages expense account. However, this is an accrued expense. We have not paid it, so we are going to create a liability account called wages payable, and that is the liability account. The liability increased by $8,000, and in order to increase the liability, we credit the liability. Now C says depreciation on the company's equipment for 2013 is $18,531. Now, when we have depreciation for the period, we debit the depreciation expense account for the amount that depreciated, and that will be $18,531. And we're going to credit an account called accumulated depreciation by the amount of $18,531. Now this account here is a contra asset account. Alright, so next we have D. The office supplies account has $240 debit balance as of December 31st, 2012. During 2013, $5,239 of office supplies were purchased. A physical count of office supplies on December 31st shows $487 worth of supplies available. Okay, how you calculate supplies goes like this. You want the beginning balance, you're going to add your purchases, you're going to subtract your ending balance to get your usage. So in this equation, the beginning balance was $240. They purchased $5,239. I apologize. And the ending balance was $487. So they had a total of $4,992. And so that $4,992 here, we are going to debit office supplies expense, because that is the account we use to reflect the office supplies used, and because it's an expense account, it's going to be debited $4,992, and we're going to credit an account called, you guessed it, office supplies, because that's our asset account where we had these initial office supplies in. And we're going to credit that $4,992. All right. Next, we have the Prepaid, which is the prepaid insurance account, had $4,000 balance on December 31st, 2012. Analysis of insurance shows that $1,200 of unexpired insurance remained at December 31st, 2013. Now, so let me break this down. If we begin with $4,000 worth of insurance and we ended with $1,200 worth of insurance, then that means we used $2,800 worth of insurance. So hence we need to debit an expense account. So it's called insurance expense, and we're going to debit that account $2,800, and we're going to credit an account called prepaid insurance, and we're going to credit that account $2,800. Now, the company has earned but not recorded $1,050 of interest from an investment in the CDs for the year ended December 31st, 2013. The interest revenue will be received on January 10th, 2014. It's a great question. So we need to record that revenue in the period which it was earned, which was 2013. So that $1,050, we need to debit an account called interest receivable. That is an asset account. And since interest we are supposed to receive increase, the interest receivable account will be debited for the $1,050. And we're going to credit an account called interest revenue. And because it's a revenue account and the revenue increased, we're going to credit revenue for $1,050. Now, I want to show you something real quick. So let's say it's 20 now it's 2014. Our last question says the company has a bank loan and has incurred but not recorded interest expense of $2,500 for the year ending December 31st, 2013. The company must pay the interest on January 2nd, 2014. Now, per the matching principle, we have to make sure that expenses are recorded in the time that they incur, or we're going to try to make sure that happens. So therefore, now we have an interest expense that needs to be put into our 2013 financials, and that interest expense is in the amount of $2,500. And because we haven't paid it, but we incurred it, we're going to put in a liability account up, interest payable, for $2,500. Now, just like the interest revenue that we received here in this transaction, I want to show you what would happen in the following year. I'm going to make another slide, and I'm going to show you how this works. So when you initially see cash but you haven't performed the work, that's a liability. And it's a liability, classified a liability, because you have taken on all the risk. Either you owe the client their money back or the products or services that you promised. So when you receive that cash, as in the case of this client, you would debit the cash account because your cash did increase, and cash is an asset, and how we increase an asset account, we debit it. But you would credit a liability account, and that liability account is called unearned revenue. And so this here is a liability account. So when you finally do the work and it okay, so in 2014, to be specific, on January 10th of 2014, when the company receives the interest payment, what they would do is they'll debit their cash for the amount of interest they received, which would be, let's say they received $2,000 in interest. And then what they would do, they would credit two accounts. So the first account they would credit is the interest receivable account, because now the other company does not owe them the interest, and so we're going to credit that account for the amount of interest receivable we accrued in 2013, which would be $1,000. I made a mistake here. Which would be $1,050. And then we would credit another account, interest revenue, for the remaining $950. That would account for 2014. So this is the amount of interest they earned for 2014. This was the amount of interest they earned on 2013, and that's when they get paid on January 14th. Now let's go back to our slide. So in the following year, we would have to, when we have to pay the interest, they're saying that we have to pay it on January 2nd, 2014. What the transaction would look like is that we would debit that interest payable account, because now we're paying it, and we're going to debit it for the $2,500 that we paid, and we're also going to debit an interest expense account. And that's because, misspelled it here. We incurred 2 days of interest. So let's say that 2 days of interest equated to $500. And then we're going to credit our cash account for the $3,000, because $3,000 is what we would pay the bank for the loan. So here we have what interest we incurred for 2013 and the amount of interest we incurred for 2014, and this transaction would close the interest transaction for that period. I hope this helps, and have a great day.